this section, I want to talk about fixed rates. My headline, a bit provocative. Are fixed rates now dead? Why am I saying that? Because, look, yesterday, the 1st of August, we had the first announcement for over a year that rates are now dropping. 0.25% came off the base rate yesterday from 5.25 to 5. So if you believe that the trajectory now is a continued downward slope and hence mortgage rates are going to also continue to fall, why on earth would you choose a fixed rate? Surely you'll be thinking, well, I want to take advantage of the ongoing savings and reductions that are going to happen over the coming months and into 2025. You would therefore lean towards a tracker or a discounted variable so that you could get the advantage of those savings as they came through. And of course, a fixed rate gives you some certainty about rates, but you ain't going to get those benefits. So the question is, well, surely you will then be looking at the discounted variables and the trackers. But here's the thing. I did some research yesterday, and what I put into the search engine was a really vanilla, straightforward, simple inquiry for a landlord who wants to borrow 75% loan to value on a standard buy-to-let with absolutely no issues, really strong rent. In other words, a type of inquiry that every single buy-to-let lender would want to lend against. We got over 2,000 products coming up as meeting those requirements. But here's the kicker. 95% of those products, that's 1,958 of the 2,000, just over 2,000 products were fixed rates. And we only had 94, that's 5%, were either trackers or discounted variables. In other words, the lenders are really skewing the picture. They're really dictating what's out there. They want certainty. They want you still to have fixed rates. Yet I think that landlords should be asking for and demanding to have on the table trackers and discounted variables to compare against the fixed rates. And right now, as I said, it really is slim pickings. However, let's still get under the surface because have a look at these two products. This is a market-leading variable discount rate that's out there right now today at 5.69. And below that is the market-leading 2-year fixed rate at 5.09%. As you can see, valuation fees pretty similar. The product fees are zero in both cases. So we really are just looking at the headline rate. And they both are asking for commitments for 2 years. So as you can see, the variable discount is 0.6% higher than the fixed rate. So here's the thing. If you are really positive, glass half full, if you think that the mortgage rates are going to be dropping quite aggressively over the next 2 years, then I think you're going to lean to a variable discount. Even though it's 0.6% higher right now, there is still that initial 0.25% to filter through to that already, plus whatever's to come in the end of the year. I've said earlier that I expect another 0.25% before we hit December, and of course further reductions into next year. So if you are optimistic that that is going to continue, then you might want to take the discount rate and bag those savings as they come through, because you think that they will get really into the low fours, maybe in a year's time, and you'll overall benefit from the savings, even though right now you're paying a 0.6% premium. If you're more level view, or indeed a glass half empty, if you think the Bank of England will be dragging their heels and there'll be a very, very prudent approach, then I suspect you're more likely to still favour a 2-year fixed at 5.09%. Now, an extra thing I really a couple of points actually I want to make before I finish. First of all, if you are leaning towards the variable discount, it is not guaranteed that the lender will drop rates just because the Bank of England rate drops. Look, there's two types of variable rate. There's a tracker and there is the variable rate. Now, the tracker quite often tracks the Bank of England rate, which means there's an absolute direct connection and link to if the Bank of England rate drops, then it is guaranteed that the lender will pass that full saving on to you if you have that Bank of England tracker. But there are also trackers that track an internal variable rate, and this variable discount is one of that type. In other words, the lender can choose whether to pass on all of the saving, some of the saving, or indeed no savings at all. So bear that in mind. Now, it would be unusual if a lender did not pass on that savings, by the way. But all I want to make the point is it is not guaranteed. So bear that in mind if you are leaning towards a variable discount. Check with your broker. Is it actually linked directly to the Bank of England tracker? And there you'll know. And if it's not, then there is another decision to be made. The last point I want to make on this section is, what about 5-year fix? Well, look, if you are active in the market, if you are building your portfolio and you are relying on the capital growth in your properties to access the equity increase over time, then I think you'll probably want a 2-year fixed anyway, so that you have that full opportunity to review your portfolio and therefore access the equity after the 2 years are up, because there's no penalties, no issues. If you take a 5-year fix, there's possibilities you could access any equity growth, but it's a lot harder. You've got limited choices. If you're not looking to grow your portfolio, not looking to access any more equity, you just want stability, then right now lenders are still pricing 5-year fix lower than the 2 years. They want you to take a 5-year fix. Just having a quick look yesterday, you can get a 5-year fix at 3.99. Now, you might go, that's fantastic, but it does come with a fee. It's a 3% fee. Now, I've put it on this slide here. So if you take that 3% fee, because it's a 5-year fix, divide it by 5, which is 0.6%, and add the 0.6 to your 3.99, then you get, well, eventually I've done a miscalculation. It's 4.59, not 4.69. Apologies for that. So you get an actual, your rate that you're looking at is 4.59. And if we go to that earlier slide, the 2-year is 5.09. So you can see that the lenders are still trying to entice you. They're dangling that carrot to take the 5-year fix because it's been priced slightly lower than the 2-year deals right now. So it's still not a clear-cut conversation or decision. So if you do want to have a conversation with the brokers, there is a link below this piece to our diary. Just book some time in, have a chat, no obligation. We'll give you all your options that are based on you. Obviously, what I'm talking about today is really generic, so please don't rely on it that it's the best product for your situation. You've heard me say this before. Talk to the brokers. They'll get your full chapter and verse about your situation and then tell you what's out there.